So we've got ABC Corporation, right? Pretty boring name unless you add a cool little logo to ABC Corp. All of a sudden, they're a hip tech company. So we're talking about the balance sheet, and it gives us the inventory and accounts payable balances for year one and year two. And then it tells us the amount of ABC's cost of goods sold for year two, and that was $50,000. Now, ultimately, it's asking us for the net cash outflows for operating activities in year two. So we're given accrual information, and we need to get to the cash flow impact. So we'll need to understand, how that relates to inventory and accounts payable, because the two are very closely aligned. So if we think about it, when we purchase materials, right? Well, that increases inventory because we're adding it to inventory. But then those material purchases, we receive invoices from vendors, and those get recorded in accounts payable. So that's how these two balances are related. So what we'll need to do is create an inventory roll forward first to figure out how much material we purchased, since we were given cost of goods sold information. And then we'll use that material purchases, plug it into the accounts payable roll forward, and that will help us figure out the cash payments made to suppliers during year two. So we'll start with the inventory roll forward. And as always, we start with beginning inventory. And then what would increase inventory? Well, that's going to be material purchases. And that gets us to cost of goods available for sale. And then to get to ending inventory, right? What decreases inventory? Well, it's when we sell our product and we recognize the cost of goods sold. So the question gives us beginning inventory, that's $5,000. Now we don't have material purchases or cost of goods available for sale. We need to solve for that. Now we do have cost of goods sold, that's negative $50,000 here. And then ending inventory is $3,000. So we'll need to work backwards here. So we'll start with ending inventory, which is $3,000, and then cost of goods sold was $50,000 negative. So if we add that back, that gets us to cost of goods available for sale of $53,000. Well, if our beginning inventory was $5,000, that means we had material purchases of $48,000. So now that we have material purchases, we can move to the accounts payable roll forward. So very similar here. We're going to start with beginning accounts payable, and then we have the material purchases, right? When we receive those invoices from vendors, that's recorded into accounts payable and will increase our balance. So we'll plug in the $48,000 we calculated. And now we need to solve for cash payments, right? So that's going to be our plug. And then the ending accounts payable is $15,000. Well, if beginning accounts payable is $12,000, and then we have material purchases of $48,000, that gets us to $60,000. And then ultimately, if at the end of the period, ending accounts payable is $15,000, well, the difference there is going to be a $45,000 cash outflow for payments made to suppliers. So that's going to be a negative $45,000. And the correct answer here is going to be $45,000. That's the net cash outflow for operating activities during year two. And you'll notice it comes just from accounts payable, right? There is no impact from the inventory roll forward because cost of goods sold is the only thing hitting the income statement there, but there's no cash outflow related to that.